What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today, we're going to talk about some year-end tax planning as we wrap up 2024. We're going to break this into a few different segments. We'll have year-end for real estate investors, then year-end for operating businesses, and finally, a little bit of year-end stuff for W-2 employees. So let's get started with our real estate investors. So one of the first things you can do is simply buy a new rental property, place it in service by December 31st, so you can take advantage of deductions for things like depreciation, maybe interest, and your other operating expenses. You might also want to consider participating in a real estate syndication. Investing in syndicates that focus on real estate can help they're typically going to pass out significant deductions, especially in the early years, due to depreciation and other property level deductions. These losses can then be passed through and used to offset other passive income, because typically your investments in syndicates will be passive. Possibly you have an exception to that, but for most people, it will be passive. Another thing to consider is a cost seg study for rentals you placed in service this year. Bonus depreciation is currently at 60%. It decreases to 40% on January 1st of 2025. Now, one thing to note is your cost seg study does not need to be done by December 31st. But you should look at and potentially run a tax projection to see what it could do for you. You actually have until you file your tax return to get that cost seg study done, so you don't need to go out and rush purchase one right now. You should, if you place your short-term rental property in service, maybe you bought a new short-term rental, try to get at least 2 customer stays before the end of the year. Those 2 customer stays are going to help prove that the average customer stay was 7 days or less, which is key to using the short-term rental loophole. We also have things like a lazy 1031. Maybe you sold a property this year and could not complete a 1031 exchange, and now you're looking at potentially dealing with a significant gain. You could buy a new property, have a cost seg study done, just make sure that property is placed in service before the 31st, or review your Form 8582 for suspended passive losses from prior years. If you've got losses hanging out there, those can be utilized to offset any gains from a property sold earlier in the year. If you are a real estate professional or need to prove material participation in some way, make sure your time logs are ready. You want to have those ready to give to your CPA or EA for preparing your tax return. You want to have those ready up front, let them have a chance to review them, because if you're ever selected for examination, an IRS audit, that's one of the first things they're going to ask for. Where's your log of time for real estate professional hours? Where's your material participation hours? So have that stuff ready to go. And make sure your bookkeeping's up to date. You want to make sure you have everything ready and put together. Your financials are done. So when it comes time to do your taxes, you're not scrambling and rushing to pull things together. You should really be doing it throughout the year, but I know how it is. Sometimes you don't get a chance and you're trying to pull together some stuff at year end, getting caught up. It happens to the best of us. Now, those are really more real estate specific. So let's look at operating businesses. What can you do if you have an operating business? Well, we were just talking about bookkeeping. The same applies to operating businesses, probably more so than it does to rentals. Make sure your bookkeeping's up to date. Also, does it make sense to accelerate purchases into December? Now, this works for cash basis taxpayers, which most taxpayers are cash basis. Now, larger businesses are quite often on accrual, but you can, if you know you need to buy things for next year, buy them now in December and take the write-off this year. You defer the taxes another year by doing this. You could also, you want to make sure, let me back up. You want to make sure you're prepaying expenses that are necessary and that you actually need for your business. You don't want to go out and start buying things that you don't need, because for every dollar you spend, every dollar of deduction that you spend, only a percentage of that results in tax savings. Even if you're in the top bracket, 37%, every dollar you spend will save 37 cents in tax. That's it. So it's not a dollar for dollar deduction here. Now, if you're looking at something that might offer a tax credit, great. Then that you do get a dollar for dollar deduction there. You can also, again, only cash basis, you can slow down or stop billing your clients. Wait and issue those invoices next year, especially if they're clients that tend to pay quickly. That way you defer that income into 2025 tax year rather than paying the tax now in 2024. And also you should run a tax projection with your CPA. This eliminates any surprises before the deadline. Even if there's not a whole lot left that you can do to minimize your tax burden, knowing what it's going to look like so you're prepared is way better than having a big surprise come April, or maybe you're filing on extension sometime in the summer. You can start setting cash aside now if you're going to need it. So those are some key things for your operating businesses. Is get things you want to get done before the end of the year. Now, for W-2 employees, unfortunately, when you're a W-2 earner, not a W-2 from your own business, that would still make you a business owner, but we work for someone else, you receive a W-2, there's not as much to do here. However, there are definitely some things you can do to help maximize your tax savings. First would be max out your retirement plans and any other employer-provided fringe benefits. Maybe you have an HSA. You can have an HSA on your own. You don't. If you have a high deductible plan at work, you can set up your own HSA. Generally, your employer will offer one. You max that out. Max out your 401k if it makes sense and you need the tax savings versus keeping that money to maybe deploy into some type of investment. But we're just still looking at tax savings right now. You can do stock loss harvesting. So this is not investment advice, but if you have positions in various stocks that are at a loss and you have gains elsewhere, you can sell the losses to offset gains that you've recognized or generated during the year. You don't want to go overboard on this because you're limited. Your stocks, if you your stock losses are going to be limited to the capital loss limitation, which is $3,000. Anything in excess of your gains, you can only deduct up to $3,000 each year, and then any remainder will carry forward. Now, another thing you could do is donate appreciated stock or consider a donor advised fund. If this is more for those that are charitably inclined. So rather than, let's talk about first the stock. Rather than donate cash, if you have stock that is highly appreciated, you might have a basis. Let's say you bought Apple stock. You invested $1,000 years ago, and now that same Apple stock's worth $5,000. Rather than sell it and pay capital gains on $4,000 and then make a deduction in cash, you can donate the stock itself. You get the full fair market value, $5,000, as a charitable deduction, while your cost basis was only $1,000. And then last, for W-2, you can invest in real estate and pay zero tax on any positive cash flow that you have going on. Those are the primary things we see for W-2 employees. There are, if you're a high income earner and you're really charitably inclined, there are different types of charitable trusts you can set up that can have a pretty significant tax impact. That's a little bit beyond what we're talking about here. This is more for your standard W-2 employees looking to get something in between now and then. We're in December already, so it's not like you're not gonna have a lot of time to meet with the appropriate attorneys and CPAs to set up a charitable trust. It'd be difficult to implement. If that's something you're interested in, feel free to contact our office. We'd be happy to talk to you about it. But that about does it for today. Just a couple quick year-end tax planning ideas before we wrap up 2024. Hope you found value in this episode. If so, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day.
This audio segment was edited by me, Adam Rothstein. If you would like help editing your podcast or narrating your audiobooks, please email me at adamrothstein29@gmail.com. That's ADAMROTHSTEIN29@gmail.com.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.